It's hard to believe that it's been over a decade since the Dodd-Frank Wall Street Reform and Consumer Protection Act was passed. I mean, just think about it. The financial crisis of 2008 shook the very foundations of our economy. Millions lost their homes, jobs vanished, and the stock market plummeted. It was chaos. So, when Dodd-Frank came along in 2010, it was like a beacon of hope, a promise that we would never let things get that bad again. But what did it really mean for us, the everyday people, and for the financial institutions that shape our economy? Let's break it down. First off, we have banking regulations. Picture this. Big banks, the ones that are too big to fail, were required to hold more capital. Why? To ensure they could weather financial storms without collapsing. They had to pass stress tests, which sounds intense, right? Imagine a bank sitting in a room sweating bullets while regulators throw hypothetical crises at them. What if a recession hits? What if there's a market crash? It's like a financial version of Survivor. The goal? To make sure these institutions have enough cushion to absorb shocks without dragging the entire economy down with them. Then there's the Volcker Rule. This one is a game changer. It put a stop to banks trading for their own profit. You know, that risky business where they gamble with your money instead of working for their clients? Yeah, that was a no-go. Banks were told, hey, you can't be playing the stock market with your clients' deposits. You need to focus on what you do best, banking. This was all about reducing the risk of financial institutions engaging in reckless behavior that could lead to another crisis. And let's not forget the Orderly Liquidation Authority. This gave the FDIC the power to step in and take control of failing banks. Think of it as a financial lifeguard, ready to jump in before someone drowns. Instead of letting a bank collapse and take down others with it, the FDIC could step in, liquidate the bank, and prevent a domino effect. It was about keeping the system stable, protecting us all from the fallout. Now, let's shift gears to consumer protection. This is where things get personal. The Consumer Financial Protection Bureau, or CFPB, was created to oversee financial products like mortgages and credit cards. Imagine having a watchdog that makes sure lenders aren't pulling a fast one on you. They enforce fair practices and protect consumers from predatory lending. It's like having a friend who knows the ins and outs of the financial world, making sure you're not getting taken advantage of. One of the most significant changes was in mortgage lending rules. Remember those days when anyone could get a mortgage, regardless of whether they could actually pay it back? Yeah, that led to the subprime mortgage crisis. And we all know how that ended. Dodd-Frank made it mandatory for lenders to verify a borrower's ability to repay before handing over the keys to a home. It's a simple concept, but it's one that could save a lot of people from financial ruin. And speaking of saving, let's talk about the stock market and investment impacts. Dodd-Frank increased transparency in the financial world. Hedge funds and private equity firms had to register with the SEC, which meant more oversight. It's like shining a flashlight into a dark corner where shady deals might be happening. Plus, there was a whistleblower program that rewarded individuals for reporting financial fraud. This created an environment where people felt empowered to speak up. Accountability became the name of the game. But what about derivatives and trading regulation? The Commodity Futures Trading Commission, or CFTC, was given the authority to regulate derivatives markets. This was crucial because it limited excessive speculation and risk-taking. If you remember, derivatives played a significant role in the 2008 crisis. By regulating this area, Dodd-Frank aimed to prevent the kind of reckless behavior that could lead to another meltdown. Now, let's talk about the effects on the economy and financial markets. On one hand, stricter mortgage lending rules helped stabilize the housing market. Fewer risky loans meant fewer people losing their homes. But, on the flip side, it also made it harder for some borrowers to qualify for mortgages. It's a balancing act, protecting consumers while ensuring access to credit. In the stock market, increased regulation led to higher compliance costs for financial firms. It's like adding more layers to a cake. It can get complicated. But many argue that this helped restore investor confidence. When you know that there are checks and balances in place, you're more likely to invest your money without fear of losing it all in a risky gamble. Now, here's where it gets a bit contentious. Critics of Dodd-Frank argue that it increased regulatory burdens, slowing down lending and business expansion. They claim that the very protections designed to create stability may have inadvertently stifled growth. Supporters, on the other hand, believe that it created a more stable financial system, one that can weather economic storms without collapsing. Fast forward to recent years, and we've seen some rollbacks, particularly under the Trump administration. The Economic Growth, Regulatory Relief, and Consumer Protection Act in 2018 eased requirements for smaller banks. It reduced stress test frequency and capital requirements for banks with less than $250 billion in assets. Some hailed this as a necessary adjustment, arguing that smaller banks shouldn't be weighed down by the same regulations as the giants. Others saw it as a dangerous move, potentially opening the door to risky practices once again. So, what does all this mean for us? The Dodd-Frank Act was a landmark financial reform, a response to a crisis that shook our world. It introduced necessary consumer protections and curbed high-risk banking practices. But its impact on economic growth and regulatory complexity remains a hot topic. Whether you see it as a safeguard or a burden, there's no denying its legacy continues to shape U.S. financial markets. As we look to the future, it's essential to keep the conversation going. How do we strike the right balance between regulation and growth? How do we protect consumers while ensuring access to credit? These questions are crucial as we navigate the ever-evolving landscape of finance. Dodd-Frank may have laid the groundwork, but the journey is far from over.